the threat of persistently higher inflation has grown. The test that we've articulated, I think, clearly has been met now. Inflation has run well above 2% for long enough. The word transitory has different meanings to different people. It's probably a good time to retire that word and try to explain more clearly what we mean. You've seen our policy adapt, and you'll see it continue to adapt. We will use our tools to make sure that higher inflation does not become entrenched. The economy is very strong and inflationary pressures are high, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting, perhaps a few months sooner.
All right. Today is Tuesday, November 30. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. Let's dive right into it. In focus. How about Powell the Hawk? No longer Dove. He got upgraded like a Pokemon. But let's start with a refresher of what I said last week. And to avoid this path, the Federal Reserve needs right now, this moment, it needs to announce they're going to end all of their purchasing programs, tapering everything. They announce a plan, a framework to increase interest rates by the beginning of next year. It has to happen. Yes, it will crash the stock market, but it is needed to save the economy from this dire scenario. Perhaps that the renomination is out of the way, now Powell has the room to be hawkish. And perhaps the renomination from Biden is, you know what, Powell? You created this mess. Now you deal with it, and you deal with the fallout. You are now forced to raise interest rates, not just taper, but to raise interest rates abruptly, which will crash the stock market and perhaps crash the economy. And that should be your rotten legacy. You should have tapered back in April. The worst case scenario is, if the economy slows down, you can put back these purchases on the table again. The risk of inaction is much larger than the risk of overreaction. Case in point, 2018, when the Fed started to raise interest rates and the market crashed. And the market spoke and said, you know what? Why would you raise interest rates right now when we don't have inflation? The Fed listened and said, you know what? You're right. We're going to reverse course 180. We're going to take all of these hikes off the table again. We're going to cut interest rates. The market recovered right away. No harm done. Once again, the risk of overreaction is much smaller than the risk of inaction, because waiting for inflation to get out of whack to react, which, by the way, the Fed is supposed to be proactive, not reactive, that risk is extremely dangerous, because you're now going to be forced to taper everything. And not only that, but you're now forced to raise interest rates abruptly, to slam your foot on the brakes, and this will crash the stock market, the real estate market, and the economy. And who knows how we're going to revive the economy after that. But this is the genius, the financial engineering by the Fed. So the bottom line is, we were expecting the Fed, specifically viewers of this channel, because we talked about this issue ad nauseum, that the Fed is late to the game, they should have tapered back in April, yada, yada, yada. And therefore, with this level of inflation, they're gonna be forced to taper everything faster and sooner than expectations. Not only that, they're gonna start raising interest rates sooner and higher than expectations. And then came the thing. You know the thing, which we can't talk about because the robot police might get upset. But the thing in essence, and of course the old version of the thing, is in essence a Santa gift, a Christmas gift to Jerome Powell and Joe Biden. Why? Because the thing tampers inflation expectations by pushing them lower. And last night we talked in details. I showed you in details how inflation expectations, and most importantly, interest rate hike expectations, went down after the thing was revealed on Friday. So think about it. The administration, the Joe Biden administration, was in a tight corner. Inflation was surging out of whack. The consumer is becoming very unsatisfied, and they're turning and blaming the administration for the inflation. Likewise, economists Many market observers have been turning on the heat on the Fed that you're late to the game, you gotta taper, you gotta start raising interest rates. The Fed, Jerome Powell, was stuck between a rock and a hard place. And then came the thing to the rescue, because the thing in the beginning is disinflationary in nature. Why? Because it hits inflation expectations. And then in the long run, the thing becomes stagflationary because it hits supply more than it hits demand. And since the arrival of the thing, the O word, which was the D word not so long ago, and then before that it was the C word, the A, the B, the C, the D, right? We're going to be like Sesame Street over here. The point being is, since the arrival of the thing, oil prices went down dramatically. Interest rate hike expectations went down dramatically. Inflation expectations are also going down. So why didn't Jerome Powell just accept the gift, stick to his guns, and say, you know what? Let the thing do the work for me. And that way I have more room to maneuver here. I can say, you see, inflation was transitory after all. Why didn't Jerome Powell accept the gift? Why did he turn an ally into a foe? Or you could see it this way. Perhaps Jerome Powell, being a hawk right now, joined the dark side, and he is slashing the stock market, the commodities market, the real estate market, the economy, and he has a little ally with him, a little Pokemon following him. It's called the Thing, like one of those video game characters, like Final Fantasy, for example, when you have a little sidekick with you who does all the magic. Because guess what? Papa Jerome used to be your ally. For all of you who are YOLOing stocks, the bulls, the pigs, Papa Jerome was your ally. But now, Papa Jerome is your enemy, and he has an ally with him called the Thing. Why? Why did Powell do this? Why couldn't he just sit down and let the Thing do the work for him by driving inflation down? Before we answer this question, and I want you to think about it, ruminate on this question for a little while, because we're going to go back and answer the question. But before we do that, remember this, what we talked about yesterday and the day before, the scenario analysis, that if the Thing is actually bad, that would be good for stocks, and the reason is it pushes inflation expectations down, and therefore the 10-year yield down, and as a result, the Nasdaq rallies higher, because big cap technology stocks, the growth and momentum stocks, are highly sensitive to interest rates. And when interest rates go down, and the expectations of interest rate hikes go down, this is supportive to the valuations in the growth and momentum sector of the stock market, specifically the big cap technology stocks, which in essence form the majority of the indices in the market, the SPY and the triple Qs, the Nasdaq. And therefore, if these mega cap names do okay, the market in essence will also do okay and hold on. So any analyst in TV, anybody you listen to who says, oh, hold on, perhaps if we get good news regarding the Thing, meaning it's not that serious, that will be bullish for stocks and the market will recover. Wrong. You have no clue what you're talking about. The Thing is the best thing that ever happened to this market. Remember when the market was rallying higher last year as cases and fatalities went higher? Because the bottom line is, what is the main driver for the stock market? Is it fundamentals? Of course not. The valuations that we have right now are far divorced from the fundamentals. Is it the retail participation? I know a lot of you think that. Things are different, bro, because us retail, we're the captain of the ship right now. No. You're the captain of the shit. Retail is only about 11% of the entire stock market at best. The main driver for this stock market is the cocaine from the Federal Reserve. To nail this stock market, every piece of news you hear, you have to ask the question, how does this piece of news impact the flow of coke from the Fed to the stock market? If the answer is it increases the flow of coke to the market, then this is positive, bullish. If it decreases the flow of coke from the Fed to the market, then it is bearish. Well, guess what? The rise of the Thing, the O, the worse it is, the better. Meaning, more cases, more fatalities, evading the current charts that we have. All of this is good news for the stock market because it gives the Fed the room to continue to print, to continue to be so-called accommodative to the stock market and the economy, and therefore it is bullish. It reverses the inflation, hiking interest rates narrative. Once again, the market doesn't care about cases, fatalities, nuclear wars, civil wars, asteroids, the extinction of humanity. That doesn't matter. So long as the coke is flowing from the Fed to the stock market, stocks will continue to go higher and higher and higher. Case in point, this morning we got bad news, the worst news possible regarding the Thing, as Moderna CEO came out and said, you know what, the O variant of the Thing will actually make the current shots that we got less effective, meaning we need new shots. This is the worst possible news. And guess what? The Nasdaq was actually trading in the green this morning, was trading higher. So anybody who says that the Thing is bad for the market, and if we get good news regarding the Thing, then the market will recover, you have absolutely no clue what you're talking about. You should not be in this business. When did the Nasdaq flush down? When Jerome Powell came out and said this: inflation will go higher, and therefore we need to start tapering aggressively and faster than what we have announced before. And that was right there and then, the moment when the stock market, specifically the Nasdaq, started to flush down. And that was the proof right there and then that the market cares about nothing except the coke from the Fed. And Powell was not only hawkish about the flow of coke from the Fed, he went further by retiring the term transitory. No more transitory. Take a listen.
How long does inflation have to run above your target before the Fed decides maybe it's not so transitory?
Well, first of all, the test that we've articulated, I think, clearly has been met now. You're absolutely right. Inflation has run well above 2% for long enough that if you look back a few years, inflation averages 2%. So I think we can say that is taken. It was not the case going into this
episode. It had been many years since we had inflation at 2%. So I think the word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
And of course, this is Powell weaseling around and saying, oh, the definition of transitory can be fluid, yada, yada, yada. How about you be a man and you just admit that you were wrong? Senator, I was wrong. I screwed up. Inflation is not transitory. And now I have to act aggressively to taper and raise interest rates. And that's going to crash stocks, real estate, and perhaps the economy. So you might want to sell at the top right now, Senator. But instead, Powell weaseled around and said, you know what? Transitory is a fluid situation, a fluid definition. 2 minutes could be transitory according to my wife. But to me, it's a good amount of time. 2 minutes could be really short or a lifetime. For example, 2 minutes when you go to the dentist and your jaws are forced wide open and somebody's sticking their fist inside your mouth. 2 minutes can feel like a lifetime. Now, I'm not sure if that was an accurate description to a dentist's office or Bill Cosby's basement. But anyways, let's revisit the question. Why didn't Jerome Powell just accept the gift and let the Thing do the work? Why did Powell decide to join the dark side and turn the Thing from a market ally to a market foe? And in essence, Powell and the Thing tag teaming the market and the economy. Why? The answer is, you guessed it, he's forced to do so. He has to. And the reason is, yes, the Thing is deflationary in the beginning. It tampers inflation expectations and interest rate hike expectations. But in the long run, it is stagflationary in nature. It will hit the supply even harder, meaning it will cause more inflation, not less. Powell acknowledged that the Thing will make the bottlenecks, the supply chain bottlenecks, even worse. And here's the illustration for you. The current situation that we have, demand is through the roof and it continues to go higher and higher and higher. Meanwhile, the supply continues to lag behind. And the reason is we have port shutdowns, factory shutdowns, and even if all of that was open, supply is not at capacity to meet this out-of-whack demand. And the demand is not stopping, it continues to go higher and higher and higher. The arrival of the Thing, yes, it will trim demand by a little bit because a lot of us will stop spending on services, meaning not going out to eat at restaurants, but it doesn't slow down the demand for goods. At least not for now. Yet it hits supply even harder because these port, factory shutdowns will linger along for a lot longer. And that will make the inflation problem even worse. If you thought the supply chain could not meet up with the demand right now, If you let the thing do its thing, the inflation problem will get even worse. And therefore, finally, Jerome Powell is facing the music and saying, you know what? This inflation crisis is not due to the supply chain. It is not a supply push or a cost inflation. It is a monetary inflation. It is a demand pull kind of inflation. And the demand is being fueled by the loose, easy money policy. And therefore, Powell is now attacking the loose, easy money policy since he doesn't have to worry about renomination anymore. And therefore, he wants to push the demand and hit it aggressively. And therefore, the inflation problem might linger, but it's not going to be as bad as if he just sat there and did nothing at all. And this is, of course, the worst case scenario for the stock market because Powell acknowledges that the thing will push prices higher eventually. So now we have the worst case scenario, the perfect storm, perhaps the end of the bull market because Powell is tightening the monetary policy. And on top of that, we have a new variant of the thing that will also hit economic activities pretty hard, perhaps cause some job losses. And this is why we said from the beginning, Mr. Powell, you should have tapered way before. So in case we have to face a situation like we have right now with an aggressive variant that perhaps evades the current shots and might cause job losses, you're gonna have the room to add that money back, the accommodation. You're gonna have the room to cut interest rates and help the economy recover and deal with the new variant. But now, by waiting this long and not acting and being reactive instead of proactive, which is in the Federal Reserve Chairman Manual, by the way, which you forgot to read, I'm sure, by doing so, you have now turned yourself into a market enemy, a villain, and you have a little ally with you called the thing, the O. And you and the O gonna work together to destroy the stock market, the real estate market bubble, the commodities market, and perhaps this economy. This is the worst case scenario, but it has to happen. There is no other choice because letting it happen will exacerbate the problem even more and perhaps push the global economy into hyperinflation, the likes that we're seeing right now in Turkey. And then you're going to have to face the music either way and be even more aggressive in interest rates hikes and tightening. And that could produce a Great Depression because this inflation is getting out of control. It is spiraling out of control. In the United States, inflation numbers are stunning. Prices are spiraling out of control for consumers. And even the Fed's favorite inflation measure, the core PCE index, is at the highest reading in over 30 years. Whether you look at it from the core headline basis or even ex-food and energy, these are the highest numbers since the 1990s. Even if you use the Dallas Fed trimmed mean method and you use the mid price, we are still seeing the highest readings since the 1990s. We will look at real rates, the effective Fed fund rates, and this is, by the way, from a few weeks ago. When you pin it to the CPI, we have the lowest readings since the 1970s. What does that mean? If the Fed doesn't act, this inflation crisis will become bigger than the great inflation of the 1970s. When you look at the food price index, these are the highest readings in about a decade. And last time we saw these high food prices, you and I know exactly what happened. The Arab Spring, the destabilization of the world. And even when we look at economic data from the US as recently as today, the economy, the inflation problem in the economy is pushing it into stagflation. And the Chicago PMI was a warning sign today. The index, meaning the economic activities, were down, the lowest reading in 9 months. Here's the problem. The activities are down. For example, order backlogs dropped to 60.8. That is 6 points below the 12-month average, as firms reported a reduction in the size of incoming orders. Pay attention now. Supplier deliveries declined slightly. However, multiple survey respondents reported November deliveries to be the slowest ever. Now, what about prices? Prices paid declined to 93.8, but still only just shy of October's multi-decade high, with ongoing higher costs for production materials reported. What does that mean? Prices will linger higher. They will stay higher as the pace of economic activities slow down. This is a classic definition of stagflation. But most importantly, when respondents are asked in the survey, are you seeing any easing up in the supply chain blockages? The majority almost 65% said no. And when asked, are you managing to pass the higher costs of doing business onto consumers? A total 78.4% of respondents were at least partially managing to pass costs onwards. So letting this inflation go, rolling the dice, will make this problem unsolvable. And perhaps we will head into stagflation, because the thing is disinflationary in the beginning, but it is stagflationary in the long run if left unchecked. What does that mean? It means that Powell is choosing slowing down the economy and risking a recession because he has to. Otherwise, the other choice is stagflation. This is a global phenomenon, by the way, a major problem right now. For example, inflation readings in Germany are stunning. The highest readings since the wall came down. We have never seen this level of inflation in Germany in the modern era. Never. Britain, the UK. This is the highest inflation in more than 2 decades in that country. And inflation across 19 nations in the Eurozone had a record high of 4.9%. And the inflation crisis are hitting Latin America the hardest. The annual inflation is 6% in Chile, 6.2% in Mexico, and it is 10.7% in Brazil, and a stunning 52% in Argentina. So again, if Powell doesn't act this way, the entire global economy will blow up. Perhaps we will have a global stagflation phenomenon, a global hyperinflation phenomenon. The entire globe will turn into Turkey, and that is not a good outcome at all. That doesn't mean the outcome from Powell tapering and raising interest rates and becoming hawkish is good either, but it is slightly better than the former. Now, the last thing I want to talk about here before we move on to the market's coverage is be careful of knee-jerk reactions in your trading and investment strategy. And the reason is Powell could go under pressure tomorrow and he does a 180 and says, you know what, all the hawkish stuff that I talked about yesterday, forget about that. I found my dove wings, and I'm not going to taper aggressively, as I said yesterday. That could happen. Keyword could. I doubt it, but he has done it before. In 2018, when Powell raised interest rates and the market threw a fit and crashed right away, Powell reversed his stance and the market recovered. The difference is back then we did not have inflation, so Powell had the luxury of doing a 180. Right now, we have inflation, and the arrival of the thing will make inflation even worse. And therefore, Powell doesn't have the luxury of doing a 180. But you gotta be prepared in case they hold a gun to Jerome Powell's head and say, you know what, do a 180 anyways. So I hope that this was clear for you, that the nonsense talk about the thing on TV, that it is, if it is good, the market goes higher, if it is bad, the market goes down, nonsense. And I hope that I clarified some of the confusion regarding Jerome Powell's actions today and why he had to do what he did. Now, if you have further questions or if this is not clear for you, please do comment in the comment section of this video. But for now, I gotta move on and cover the market for you, starting with the market performance today. And here we go. The Dow Industrial Average down by 652.22 points, or a decline of 1.86%. The Nasdaq down big, 383.91 points, or a decline of 2.41%. The S&P 500 down 88.27 points, or a decline of 1.90%. And what about the sector's performance today? Pathetic across the board, no medals awarded at all. The laggards led by communication services, utilities, and consumer defensives. Every single sector of the market closed in the red today. What about the advance to decline ratios? For the NYSE, 13% advancing versus 84% declining. The Nasdaq, 27% advancing versus 70% declining. And folks, we had 461, once again, 461 names in the Nasdaq reaching a new 52-week low. Now, when we see these exaggerated numbers to the downside, that always elicit a reaction for a rebound, at least in the futures overnight market. That doesn't mean that we're going to see a massive dip buying and a recovery. That's not going to happen right now until Powell reverses his stance. Absent of that, the pain will continue. But bear in mind, the mechanics of the market say a rebound usually follows after exaggerated numbers to the downside like you're seeing right now. Moving on to futures, what's going on here? A massacre, bloodbath across the board. Oil down, softs down, metals down, grains down, everything is down. But let's talk about energy commodities first. The WTI was down over 4%, so was the Brent. We also had declines for natural gas, gasoline, heating oil. So what's going on here? You have the double whammy against oil prices. Number one, forget about the release from the SPR. That doesn't mean anything at all. Crude oil prices actually shot up higher after that. But we have the thing, the arrival of the O, which hits oil prices psychologically speaking, because the thinking is if we have more cases, we have more lockdowns, more restrictions, and therefore less demand for oil. In reality, however, in the long run, as we've seen last year, when we had lockdown and restrictions, even in this country, and oil prices continued to surge higher either way. But the thing remains a weak enemy for crude oil prices. Why? Because every time we have cases rising and more restrictions, yes, oil prices dive down initially, but then we have the shot optimism, and then we have the Fed stimulating the economy along with other central banks, and that money that gets printed out of thin air has to chase commodities as the market looks forward, and right away oil prices recover. When we look at the supply to demand dynamics in the oil market, the gap between demand and supply is really narrow. It's not that big of a deal. It is not the driver of higher oil prices. Matter of fact, even before the arrival of the thing, the O, we did not have legitimate demand for oil. Just so you know, the global oil consumption for the year 2021 versus 2019 is down. So there is no legitimate surge in demand. But there is a lot of speculation and a lot of money landing in crude oil futures. And therefore, that is pushing prices higher because it gives fake demand. It gives you the illusion that there is demand surpassing supply. But here's the bottom line when it comes to crude oil prices. Who's in charge of the supply? Who has the strongest hand in controlling supply? Because let's say, hypothetically speaking, of course, the thing is causing lockdowns and restrictions and the demand for oil goes down. And now you have the Biden administration, other countries releasing barrels from the strategic reserves and therefore supply shooting higher. And then oil prices go down because the gap between demand and supply is reduced, and you might get into a case where the supply surpasses demand. But who has the power over supply? The answer is OPEC. So even if the demand goes down and Biden releases barrels from the SPR, OPEC has control to reduce the supply dramatically and maintain that gap between supply and demand, and therefore maintaining higher oil prices. And therefore, up until yesterday, I was bullish on oil prices, that the dip should be bought and oil prices will surge higher because OPEC has control over the supply. And even if the demand goes down, OPEC can reduce the supply dramatically and maintain these prices higher anyways. But here's the question. Who is in charge of demand? Who is in charge of the stimulation and the money landing in oil futures and the speculation, pushing oil prices higher and pushing the demand, at least on paper, higher? The answer is this man, Jerome Powell. And Jerome Powell has spoken today, and he said he's going to reduce that demand. He's going to reduce the loose money policy by tapering aggressively and perhaps raising interest rates sooner. That will crush the demand right away. So whether OPEC has the control or not, if the demand is crushed substantially, not just the temporary crush by the thing, but a legitimate reduction in demand and the speculation in the market, then it doesn't matter what OPEC does. They can reduce the supply all they want unless they go to zero and produce no barrels at all. Oil prices will get crushed. But understand this, tapering right now, tapering is not going to do it. It's not the one. Raising interest rates is the one, but it's a game of expectations. Now that he wants to taper faster or more aggressively, the assumption is, the expectations are, that he will raise interest rates sooner and aggressively too. And therefore, the demand goes down, the supply goes higher, and in time, Jerome Powell pops the bubble in the commodities market. Now, lastly, before we move on from the commodities market, what about lumber? Why is lumber surging higher today? The answer is every time we have interest rates diving down, at least for now. Remember, Powell might start hiking rates higher. So for now, the drop in the 10-year yield is good for what? A drop in mortgage rates. A drop in mortgage rates is good for the housing market, which is good for home builders, which is good for lumber, because home builders now have to buy more lumber. The demand goes higher, lumber prices also move higher. This is the dynamic for now. But if you see interest rates and the 10-year moving higher, once again, then lumber prices will also dive down. Moving on to the big casino, The options market, what's going on here? The hottest table by far is Apple, and watch out for this. On CNBC today, they were saying Apple is the only stock that bucked the trend. Apple closed in the green by about 3% because it is quote-unquote safety. Give me a break. Is it really safety, or is it due to the mania in the options market? Today, they're stampeded to buy call options in Apple, and I'll show you that in a second, but here it is, Apple at number 1, with over 3 million contracts exchanging hands today. This is a massive surge in volume for Apple, and about 74% of those were calls. Why? I have no clue, but they did it anyways, and that was the main driver for Apple shares to buck the trend, not because it is safety. Number 2, Tesla, the souffle, with a little over 700,000 contracts, about 49% of those were calls. And number 3, AMD, with a little over 600,000 contracts trading today, about 70% of those were calls. And here are the options, the call options for Apple. And these, by the way, for the expiration date of this upcoming Friday. Just so you understand. We saw massive volume starting from the 160, but specifically for the 165 calls. Almost 500,000 contracts of the 165 calls traded hands today. But they're not carrying on these calls as open interest. They're trading them in and out, to elicit a gamma squeeze and manipulate the stock higher. Was it done by design? Who knows? Was it done by a certain entity who wanted to soften the blow today? Who knows? But one thing we can agree on is, as Apple goes, so will the market. So somebody was lying today. Was it Apple or was it the market? If you believe that Apple was artificially pushed higher via the options market activities, then Apple is the one who's lying, and Apple will start to flush down sooner or later. But here are the unusual activities that took place in the options market today, starting with the ticker WE for WeWork. The buying calls here, the $10 calls for the expiration date, New Year's Eve, with expectations that the name will pop higher by more than 15% or so by then. They paid about 55 cents apiece to enter this trade, all in all spending about $1 million. What about the ticker IWM? This is a big one, by the way. The buying puts here, the 206 puts for the expiration date, January 21st. With the expectations that the Russell 2000 will drop by more than 6% by then. They paid about $5.50 apiece to enter this trade. All in all, spending about $10 million. What about the trade for the ticker UVXY, a proxy of the VIX? They're buying puts here with only 3 days till expiration. What does that mean? Somebody's saying that we're going to have a short-term bottom, at least for now, in the SPY and the market in general, but that will be a top for the VIX, at least for now. For this week. So they bought the $18 puts for the expiration date this upcoming Friday with the expectations that the UVXY will drop by more than 11.5% by then. They paid about 70 cents apiece to enter this trade, all in all spending about $1 million. What about the trade for the ticker DVN for Devon Energy? They're buying the dip here, perhaps an oversold bounce. They're buying the 46 calls for the expiration date, January 21st, with the expectations that the name could rebound higher by more than 9% by then. They paid about $1.90 apiece to enter this trade. All in all, spending about $2 million. Lastly, what about the trade for the ticker DOMO for Domo? They're buying puts here, the 55 puts for the expiration date, January 21st, with the expectations that the name could drop down, crash actually, by more than 24% by then, and they paid about $2.30 apiece to enter this trade. All in all, spending about $2.5 million. Moving on to the heat map analysis. What's going on here? A bloodbath across the board, sparing very few names. The storm that we got today, the tsunami of selling, the outliers, bucking the trend. Apple, we talked about that, driven by the options activities. And then we have Pfizer. We know a lot of money's moving to Pfizer because Merck, that's no bueno. The pills are not that good. Yes, they got approved, but nobody's going to use them if you have a choice between Merck and Pfizer, at least for now, given the efficacy rate. We have some money chasing Moderna, but again, Moderna CEO came out and said, you know what, my shot's not going to be good. Pfizer CEO, who's by the way pissed off that his stock is not going higher, Pfizer CEO is pumping. He's all over TV right now. Our jabs are going to work. Yes, they might go down in efficacy, but they still work. The pills work. Please buy my stock. And we are buying his stock right now. Now, we have a few pockets here and there that also bucked the trend, closing in the green due to options activities and certain short covering. For example, Li Auto also popped higher, but we also have notably Tesla, also closing in the green. And my belief is if this market crashes, the last two blocks to fall will be Apple and Tesla. That's just my belief from my experience and studying of the dot-com bubble. Moving on to the charts analysis, starting with the SPY 30 minutes chart. What's going on here? We started gapping down in the morning due to the news from Moderna. This is the SPY, not the Qs, by the way. Where did the SPY stop? Where did it catch support from? The answer is 461.5. Catching support from the support line and then reversing right away before closing the gap. That was the signal right there and then from a technical analysis perspective. When you're about to close a gap and you reverse before doing so, and then you violate the support from which you bounced from, what more do you need before placing a short? Because the SPY continued to flush down from that point, closing at the lows of the day. This is not a good signal, by the way, indicating that perhaps we will see more pain to come. We're eyeing the next support at 453.11. You can call that 453 even. Doesn't matter to me. It's a zone. It's not an actual number. What about the SPY's continuous contract, the daily chart? We had the double top and the chart is flushing down. Yes, we had the rebound, the dead cat bounce, rebounding all the way till the half of the body of the previous candle. And then the primary move, which was down, continues. This is classic technical analysis. We also have negative divergences on both the RSI and MACD indicators. Matter of fact, the RSI is plummeting right now. On top of that, the move to the downside today came with significantly higher volume, and therefore we have a confirmation that we have more pain to come. And every bounce is an opportunity to sell the rip, at least for now. What about the weekly chart for the SPY? Again, working exactly as we expected. You're going to reach the top upper band of the channel, facing that resistance, and you go down to visit the lower band of the channel, the support, and you bounce back and forth like a ping pong. This is what a healthy, bullish trend looks like. Now, we're going to start to wet our diapers. If the support is broken, if the channel is broken to the downside, then it's time to run. But let me scare you a little more here by showing you the monthly chart for the SPX, the cash index for the SPY, the S&P 500. This is the monthly candle that we have right now. What does this look like, by the way? A shooting star candle, which is a classic reversal candle. I'll give you about 5 seconds to spot it. What do you see here? Here it is. I see the symmetry from before the crash last year. And is it going to be repeated this time around again? Uh-oh. Moving on to the Q's 30 minutes chart. What's going on here? We had a bull flag formation, and regardless of the bad news from Moderna, the Nasdaq was moving higher, as we expected, by the way, because the thing is not a problem for the Q's. It is actually a supportive figure for the Qs. And then came the comments from Powell, and the rest is history. The Nasdaq flushed down and now forming a bear flag formation. What does that mean? Sooner or later, we will be at the support zone once again. Whether we're going to bounce or not, that remains to be seen. But here's the daily chart for the continuous contract on the Nasdaq. We have negative divergences. Both the RSI and MACD indicators are trending down. We have a sell-off on higher volume, and I told you when you break the channel like this too early, you're not going to recapture it. It's over. It's done. And if that wasn't enough, what if what we're seeing right now is a formation of a head and shoulder pattern, which is a topping pattern, which will result in a flush down. And here's a 30 minutes chart for the IWM, the Russell 2000. A lot of pain here. Flushing down all the way to the next support, 218. For now, 218 is holding. Can we have an oversold bounce? We'll see. But remember, unlike the Qs, the thing is actually an enemy for the IWM because it contains the reopening names, the value names. And on top of that, you have Powell tightening, so the IWM has a double whammy smacking its head right now. What about the Dixie? What's going on here? It went all over the place today. And the reason is we got bad news from Moderna in the morning, and then came Powell, and we have the whipsaw back and forth, back and forth, back and forth. But the technicals alone say the dollar has stopped, and it is time for the dollar to continue to move down. Even if Powell is going to taper more now, which is supportive to higher dollar, we always talked about buy the rumor, sell the news, meaning we're going to bid the dollar higher on tapering anticipation, but when tapering actually happens, we have sell the news and the dollar flushes down anyways. Are we about to see that? From my perspective right now, I see the support for 96 is broken. I see the dollar diving lower. Will that be good enough for gold? Who knows? Because gold is actually diving down. Not by a lot, but it was a negative day for gold anyways, because we have the confusion. We have to digest the information that we got today. And it all depends on the two enemies of gold, the dollar and yields, specifically for the 10-year. If both of them go down, gold goes higher. But if the market reads it differently and either the dollar or the 10-year yield starts to move higher again, then gold will flush down, and that bear flag pattern will play out. And here it is, a chart of the 10-year yield, perhaps the most important chart to watch right now, because it went down initially on the bad news from Moderna, but then recovered a little bit on the hawkish comments by Powell. Now comes the digestion period in the bond market. Are they going to read it as Powell being hawkish, moving sooner to raise interest rates? Or are they going to say, you know what, the rise of the thing and the fact that it evades the shots, that will slow down the picture for growth and economic activities dramatically, and therefore we will see inflow into so-called safety, meaning bonds. And bonds have an inverse relationship between price and yields. If we see a lot of buying of bonds for quote-unquote safety, which is actual safety, not Apple, by the way, then the price of bonds will move higher, yields will go down. This remains the most confusing and most challenging aspect for all analysts, by the way. Are prices going to move higher, or are yields going to move higher? For now, the chart of the 10-year yield had a head and shoulder, followed by a reverse head and shoulder. And now the update is, what if we have a double bottom? And yields move higher from now. But for now, this moment, bond prices are winning, not yields. And therefore, the TLT weekly chart moving higher again. It needs to continue to move higher beyond 149, where we don't have this argument and doubt anymore. Is it a false breakout? Why is it still hugging 149? Yada, yada, yada. And I would say that will happen when the TLT reaches 160. And if that happens rapidly, then we have the answer right there and then. Bond prices will move higher, yields will go down. But so long as the TLT continues to hug 149 and yields on the 10-year continue to hug 1.5, the battle, the debate, the mystery continues. What about the VIX 4-hour chart? Again, the MACD is still green. It is trading above the neutral line, above zero. Yes, it is overextended, but it can continue to go on and on and on for a little while. If it does, then we have higher readings in the VIX, which means more pain for the SPY. I see a little bit of resistance at these levels, but here's the important chart to look at. The weekly chart for the VIX. We have a sloping line of resistance. If that line is broken, then run for the hills, because we have something major brewing here. We're going to have another pop that perhaps will rival the pop from last year, which will mean the SPY, the Qs will crash. And we will perhaps see the end of the bull run once and for all. And here is a daily chart for Apple closing above the channel. And of course, the algos are looking exactly at what you and I are looking at right now. You combine that with the options buying, the call options buying, and you have a storm to push this stock higher. Is it sustainable? Is it not sustainable? Who knows? But for now, looking at the chart, this is a bullish development. The chart is breaking above the upper band of the channel on higher volume, by the way. So again, the mystery is, who's lying, the market or Apple? Because you and I know, as Apple goes, so will the market. But I'm moving on to Tesla daily chart. What's going on here? No update. The test is going to be 1,174.5 once again. If Tesla fails, this will be the third time. It's not going to be confirmation of a change in the trend or the momentum. But the question from that point will be, how far will the projection take us? Is it going to take us all the way to pierce below 1,000? Is it going to take us to form a lower low? If any of that happens, then the bears have a confirmation to double down. Moving on to tulips, BTC, what's going on here? Still holding the bounce from the support zone. And if I had to lay a bet here, I would bet that BTC will move higher. I know it doesn't make sense if the market is selling off. If we have a risk off mode, then tulips should go down. But the technicals that I'm looking at right now, I see the chart have retested 53,200 and retested 55,300. Tested that zone multiple times, and it continues to hold. We're now waiting and waiting and waiting for buyers. The chart is asking, I'm ready to go higher here. Where are the buyers? If the buyers show up, the BTC will have an easy run higher. But watch out here. If the chart continues to linger on at this zone, consolidating, then this will be a bad signal. that buyers are nowhere to be found, and therefore the chart will take another leg down. Perhaps it will find buyers at a better price. And lastly, here is the chart for AMC, now losing the support of 36.5, and perhaps the next destination will be 32. That will be the last support. After 32, we will see the margin calls, the capitulation from the apes, whatever remaining of the apes. We're going to see shorts piling in. We're going to see insiders dumping, yada, yada, yada. And the end of the AMC run will be right there and then. 32 must be defended. You got to go ape shit to defend 32. Anyhow, we're moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the ADP report. This will be important. A catalyst for the upcoming non-farm payrolls. Then we have the manufacturing PMI, the ISM manufacturing index. We also have construction spending. And most importantly, we have round number 2, the tag team of Powell Yellen. Will Powell walk back his comments today and become a dove again? We'll see. I doubt it, but maybe the pressure is too high that he has to do a 180. We'll see. And then we have the Fed's beige book, and this will be important regarding the outlook for the economy, inflation, etc. Anyhow, folks, this is all I got for you for now. Thank you for listening. Thank you for watching, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.